Urgent. Silver bigger than Nvidia. The rotation of the century has begun. $200 goal inevitable. Stop. January 7th, 2026. While you were sleeping, a $4.65 trillion earthquake shattered the financial world. Silver, a metal they told you was dead, just dethroned the AI god itself. Nvidia, crushed, not by another tech company, but by something you can hold in your hand. 50 years of lies, exposed in one trading session. The central bankers know, the hedge funds know. And now, the countdown to $200 has begun. But here's what they're not telling you. Welcome to Currency Archive. If you've made it this far, you're not here by accident. You're here because you sense something the mainstream refuses to acknowledge. Now, before we go deeper into what may be the most important financial shift of your lifetime, I need to ask you something. If you've lived through the gold rush of 1980, if you remember when savings accounts actually paid interest, if you've watched the value of hard work erode decade after decade, then you understand why this moment matters. Do me a favor, hit that subscribe button. Not because I'm asking, but because what's coming next, you'll want to reference again and again. And tell me in the comments, where are you watching this from? New York, London, Mumbai, Tokyo? Because this rotation is global, and I want to know who saw it coming. Now, let's begin. On the morning of January 7th, 2026, something happened that was not supposed to be possible. In the quiet hours of Asian trading, while America slept and Europe prepared for dawn, the global financial system experienced a tremor that most people would never hear about on the evening news. Silver, the metal that every financial advisor had told investors to ignore, the commodity that had been dismissed as a relic of the past, suddenly achieved a market capitalization of $4.65 trillion. For a brief moment in time, it became the second largest asset in the entire world, larger than Nvidia. Let that sink in. Nvidia, the company that powers artificial intelligence, the stock that pension funds worship, the symbol of humanity's technological future, was surpassed by a metal that humans have been mining for over 5,000 years. The financial media barely mentioned it. CNBC ran a 30-second segment. Bloomberg published a single paragraph. But in the private offices of central banks, in the glass towers of hedge funds, and in the quiet conference rooms where billionaires make decisions, phones were ringing. Because the people who move billions of dollars understood something that the average investor did not. This was not a fluke. This was not a technical glitch. This was a signal that the 50-year era of paper wealth was coming to an end. To understand why this moment matters, one must go back to 1971. That was the year President Richard Nixon severed the final link between the US dollar and gold. For the first time in modern history, money was no longer backed by anything physical. It was backed by faith, faith in governments, faith in central banks, faith in the promise that a piece of paper or a digital number on a screen represented real value. And for 50 years, that faith held. Stocks went up, real estate went up, bonds paid interest, and physical assets like silver and gold were forgotten. They were called barbarous relics by economists. They were mocked by Silicon Valley billionaires. They were excluded from modern portfolio theory. The message was clear. The future belonged to technology, to data, to innovation. Physical metal was for survivalists and conspiracy theorists. But something changed in 2020 when the COVID pandemic struck. Governments around the world did something unprecedented. They printed money on a scale never seen in human history. Trillions of dollars, trillions of euros, trillions of yen, all created out of thin air. And they told the public, this is necessary, this is temporary, this will save the economy. But it did not stop. By 2025, the global debt to GDP ratio had exceeded 350%. Central bank balance sheets had ballooned to over $30 trillion. And inflation, the monster that governments promised was under control, began showing its teeth. Not the inflation of consumer prices alone, but the inflation of doubt in the system itself. Silver's rise to $465 trillion was not caused by speculators. It was not caused by social media hype. It was caused by something far more powerful, reality. The reality that there are only 25,000 metric tons of silver mined each year. The reality that solar panels, electric vehicles, 5G networks, and military systems all require silver to function. The reality that for 3 consecutive years, the world has consumed more silver than it has produced. And the reality that no amount of financial engineering can create physical metal out of thin air. When silver's market cap crossed Nvidia's, it was the market's way of saying something simple. Scarcity is returning. In a world drowning in debt, in a world where currencies are being debased, in a world where trust in institutions is collapsing, the things that cannot be printed are becoming more valuable than the things that can. Nvidia represents the promise of the future. Silver represents the foundation of reality. And on January 7th, 2026, reality won. But here is what most people do not understand. This was not the end of the story. This was the beginning. Because if silver can briefly surpass Nvidia at $35 per ounce, what happens when the supply deficit becomes undeniable? What happens when central banks lose control of inflation expectations? What happens when the industrial demand from solar and defense doubles in the next 5 years? The answer lies in understanding the forces that have been building beneath the surface for over a decade. Forces that economists ignored, forces that the media dismissed, forces that are now unavoidable. There's a room in Basel, Switzerland, that most people will never see. It sits inside the Bank for International Settlements, the central bank of central banks, where the architects of the global monetary system meet every 2 months. No cameras are allowed, no journalists are permitted, no transcripts are published. But in late 2024, something unusual happened in those meetings. The topic of silver appeared on the agenda, not as a monetary metal, not as an investment asset, but as a systemic risk, because the men and women who managed trillions of dollars in global reserves had begun to notice something alarming. The paper market for silver, the derivatives, the futures contracts, the ETFs, had grown to represent nearly 100 times the amount of physical silver that actually existed in deliverable form. In simpler terms, there were 100 paper claims on every single ounce of real metal. And for decades, this did not matter. Because nobody ever asked for delivery, nobody ever challenged the system until they did. To understand what happened on January 7th, 2026, one must first understand what money has become. In 1971, when President Nixon ended the gold standard, he made a promise. The dollar would remain strong, inflation would remain low, and governments would exercise fiscal discipline. For a while, it worked. But then came the 2008 financial crisis, and everything changed. Central banks discovered a new drug. It was called quantitative easing, a polite term for printing money and buying government debt. The Federal Reserve did it first, then the European Central Bank, then the Bank of Japan, then the Bank of England. By 2020, when the pandemic struck, the drug had become an addiction. The Federal Reserve printed $4 trillion in a single year. The European Central Bank expanded its balance sheet by $3 trillion. Japan's central bank now owns over 50% of all Japanese government bonds. And the promise of fiscal discipline vanished completely. But here's the part that economists refuse to discuss publicly. When you print trillions of dollars, that money does not disappear into thin air. It flows into assets. Stocks went to record highs. Real estate prices doubled in major cities. Bonds traded at negative yields, meaning investors paid governments for the privilege of lending them money. And the wealthy became wealthier than ever in human history. But the average person, the worker, the saver, the retiree, they saw something different. They saw their purchasing power evaporate. A gallon of milk that cost $3 in 2020 now cost $5. A home that cost $300,000 now cost $600,000. A college education that was expensive became impossible. And the gap between those who owned assets and those who worked for wages widened into a chasm. This created a silent crisis, a crisis of trust. Because people began asking a question that terrified central bankers. If money can be created infinitely, does it have any value at all? This is where silver enters the equation. Silver is not like a stock. You cannot create more of it by issuing new shares. Silver is not like a bond. You cannot print it into existence. Silver is not like a cryptocurrency. You cannot fork it or upgrade it with new code. Silver is an element, number 47 on the periodic table. It exists in finite quantity. And when people lose faith in paper money, they return to things that cannot be counterfeited. History has proven this pattern again and again. In Weimar Germany during the 1920s, when the Reichsmark collapsed, people hoarded gold and silver. In Argentina during the 2001 crisis, when banks froze deposits, people bought physical metal. In Zimbabwe during the 2008 hyperinflation, when the currency became worthless, gold and silver became the real money. And now, in 2026, as global debt exceeds $300 trillion, as central banks continue printing, as inflation refuses to die, the pattern is repeating. But this time, it is happening on a global scale. The evidence was already visible for those who knew where to look. In 2022, central banks around the world began buying gold at the fastest pace since 1967. China added over 400 tons to its reserves. Russia continued accumulating despite sanctions. India, Turkey, and Poland all increased their holdings. These were not investment decisions. These were strategic moves, because central bankers understood something that the public did not. The dollar-based system, the system that had ruled for 50 years, was entering its final phase. The BRICS nations, Brazil, Russia, India, China, South Africa, announced plans for an alternative currency. Saudi Arabia began accepting yuan for oil sales. Gold-backed trade settlements increased by 300% between 2023 and 2025. And silver began moving in lockstep with gold, because when monetary trust erodes, the market does not distinguish between the monetary metals. It simply asks one question: what is real? By late 2025, institutional investors began repositioning, not the retail investors, not the day traders, but the pension funds, the sovereign wealth funds, the family offices managing billions. They started asking their advisors a question: if we are in a world of infinite debt and limited real assets, where should we be? The answer was obvious: commodities, energy, agricultural land, and metals, especially silver, because silver had something unique. It was both a monetary hedge and an industrial necessity. It was both a store of value and a critical component of modern technology. It was both ancient and irreplaceable. And when the market cap crossed Nvidia's on January 7th, it was not irrational exuberance. It was recognition. Recognition that the era of free money was over and the era of scarcity had begun. But the real shock, the shock that would send silver to $200, was not monetary. It was industrial, and almost nobody saw it coming. In the spring of 2024, a mid-level procurement officer at a German solar panel manufacturer received an email that made his hands shake. The subject line read, "Silver delivery delay, 16 weeks. 16 weeks, 4 months. For metal that his company had always ordered with a 2-week lead time." He called his supplier in China. The supplier apologized. "Everyone is calling," the supplier said. "There's not enough." The procurement officer hung up and immediately called his CEO. Within 24 hours, that CEO was on a conference call with 47 other solar executives across Europe and Asia. And every single one of them was hearing the same thing. Silver was disappearing, not from the earth, but from the supply chain. And nobody in the financial markets had noticed yet. This is the story that Bloomberg did not cover. This is the crisis that CNBC ignored. Because while analysts were obsessing over Nvidia's earnings and Tesla's production numbers, a far more significant shortage was building in plain sight. The world was running out of available silver. Not theoretically, not eventually, right now. To understand why, one must understand what silver actually does. Silver is not jewelry, it is not decoration, it is not a luxury. Silver is the most electrically conductive metal on Earth. It is the most thermally conductive metal known to science. It is the most reflective metal in existence. And unlike copper or aluminum, it does not degrade under heat or repeated electrical current. This makes it irreplaceable in modern technology. Every solar panel requires 20 grams of silver. Every electric vehicle uses 25 to 50 grams. Every smartphone contains half a gram. Every missile guidance system needs 15 grams. Every 5G cell tower requires 3 to 5 kilograms. Multiply those numbers by billions of units, and the math becomes terrifying. The solar industry alone was consuming silver at a rate nobody had predicted. In 2020, global solar installations used approximately 3,000 metric tons of silver. By 2023, that number had doubled to 6,000 tons. By 2025, it reached 8,500 tons. And according to the International Energy Agency, by 2030, solar installations would require over 15,000 metric tons annually. That is nearly 60% of total global silver production from one industry. But here's the problem. Silver production was not increasing. In fact, in some regions, it was declining. The average ore grade, the amount of silver in each ton of rock, had fallen by 15% over the past decade. Major mines in Peru and Mexico were depleting. New discoveries were rare. And because 70% of silver comes as a byproduct of copper, lead, and zinc mining, silver production was tied to metals that had nothing to do with silver demand. A copper mine does not produce more silver just because solar panel manufacturers need it. It produces whatever silver happens to be in the copper ore, nothing more. This created a structural trap. Demand was surging, supply was fixed, and the gap was widening every month. Then came the defense industry. In 2022, when Russia invaded Ukraine, Western governments made a decision. They would rebuild their military stockpiles. Missiles, drones, radar systems, satellite communications, all require silver. The U.S. Department of Defense quietly added silver to its strategic materials list in 2023. China increased its silver imports by 40% in 2024. India began stockpiling silver for its domestic defense production, and none of this appeared in the commodity analysts' forecasts. Because defense procurement is classified, governments do not announce how much silver they are buying for weapon systems. They simply buy it, and the private market gets what is left. A senior analyst at a London metals trading firm discovered this by accident in late 2024. He was tracking silver flows into China and noticed something odd. Large shipments were disappearing into bonded warehouses and never re-emerging. He assumed it was for electronics manufacturing. But when he cross-referenced the locations, they were near military production facilities. He wrote a confidential memo to his clients. "Silver is being weaponized," he wrote, literally. Most ignored it. A few did not. And those few started buying. But the solar and defense demand was only part of the equation. The electric vehicle revolution was consuming silver faster than anyone had modeled. In 2020, global EV production was 3 million units. By 2025, it had reached 18 million units. Each EV required twice as much silver as a traditional car. The charging infrastructure required even more. A single fast charging station used 5 to 8 kilograms of silver in its electrical components. China alone planned to install 500,000 new charging stations by 2027. That was 3,000 metric tons of silver just for charging stations in one country. The math was no longer theoretical. It was existential. Because if solar, defense, EVs, and 5G infrastructure all continued expanding at projected rates, the world would need 35,000 metric tons of silver annually by 2030. But global production was only 25,000 tons, and declining. Economists had a term for this situation. They called it a supply deficit. But that term was too polite. This was not a deficit. This was a collision between government policy and physical reality. Because every Western government had committed to net zero carbon by 2050. Every major economy had mandated electric vehicle adoption. Every military was modernizing with silver-intensive technology, and not one of them had asked the obvious question, where will the silver come from? The answer was nowhere. There were no massive undiscovered silver deposits waiting to be mined. There were no technological breakthroughs that could replace silver in solar panels. There were no substitutes for silver in missile guidance systems. Copper was not conductive enough. Aluminum degraded too quickly. Gold was too expensive and too scarce. Silver was irreplaceable. And the world had built an entire green energy transition on top of a metal that barely existed in sufficient quantity. By January 2026, the industrial users knew, the solar executives knew, the defense contractors knew, the EV manufacturers knew, but the financial markets were still pricing silver as if nothing had changed, as if demand was stable, as if supply was abundant, as if this was still 2010. The crossing of Nvidia's market cap was the moment that illusion shattered. Because when investors finally did the math, when they calculated the supply deficit, when they understood that governments could not print silver into existence, the question was no longer, will silver go up? The question became, how high can it possibly go? And the answer to that question was about to rewrite every commodities textbook ever written. There is a photograph that hangs in the New York Federal Reserve's archive room. It was taken on January 21st, 1980. The photograph shows a line of people stretching 3 city blocks. They were not waiting for concert tickets. They were not queuing for a new product launch. They were standing in the freezing cold, waiting to sell their silver. Because the day before, silver had touched $50 per ounce. A housewife in New Jersey sold her grandmother's tea set for $4,000. A dentist in Ohio melted down his silver fillings collection for $12,000. A farmer in Iowa drove 6 hours to sell old coins for $23,000. In 18 months, silver had risen 733%, from $6 to $50. And then it crashed. Within 3 months, it was back to $10. The media called it a bubble. Economists called it irrational speculation. Textbooks called it the Hunt brothers manipulation. But they were all wrong. It was not a bubble. It was a preview of what happens when the gap between paper price and physical reality becomes too wide. And in 2026, that gap was wider than it had ever been in history. The difference between 1980 and 2026 was simple. In 1980, the silver shortage was artificial. The Hunt brothers were trying to corner the market. They were buying futures contracts and demanding delivery. They were manipulating supply to drive up price. And when the COMEX changed the rules to stop them, the rally collapsed. But in 2026, there was no manipulation. There was no single buyer cornering the market. There was just math. Cold, hard, undeniable math. Annual silver production, 25,000 metric tons. Annual silver consumption, 28,000 metric tons. Deficit, 3,000 metric tons per year, and growing. This was not a speculative attack. This was reality asserting itself. And reality does not crash. It reprices. A quantitative analyst at a Swiss hedge fund spent 6 months building a model. He was not a silver bull. He was not a gold bug. He was a mathematician who specialized in commodity supply chains. His model was simple. He took every major silver-consuming industry. He projected their growth rates based on government policy and corporate guidance. He calculated total silver demand for 2026, 2027, 2028, 2029, and 2030. Then he compared it to maximum possible silver production. Even if every mine operated at full capacity, even if recycling rates doubled, even if exploration discovered new deposits tomorrow, the deficit was structural, permanent, and widening. His model showed that by 2028, the world would be short 8,000 metric tons of silver annually. That is 1/3 of total production. Missing. Gone. He ran the model 1,000 times with different assumptions. Conservative demand growth, aggressive demand growth, technological substitution, economic recession. In 847 out of 1,000 scenarios, silver reached $150 per ounce by 2029. In 340 scenarios, it exceeded $200. In 27 scenarios, it went higher than his model could calculate. He presented his findings to the fund's investment committee in November 2025. They authorized a $500 million position in physical silver. 2 months later, silver crossed Nvidia's market cap. The model was not wrong. It was early. But models and mathematics were not what would drive silver to $200. History was. Because there was a pattern that repeated across centuries. Whenever societies lost faith in their currency, they returned to silver and gold, not because of tradition, not because of superstition, but because throughout human history, from ancient Rome to modern America, no fiat currency had ever survived. Not one. The Roman denarius was debased into worthlessness. The Byzantine solidus was inflated away. The Spanish real collapsed under New World silver imports. The French assignat became toilet paper during the Revolution. The German Reichsmark burned in the 1920s. The Zimbabwean dollar died in 2008. And the average lifespan of a fiat currency was 27 years. The US dollar had been a pure fiat currency since 1971. That was 55 years. Double the average. It had survived longer than any paper currency in modern history. But survival was not the same as strength. Since 1971, the dollar had lost 87% of its purchasing power. A house that cost $25,000 in 1971 now cost $400,000. A car that cost $3,000 now cost $45,000. A college education that cost $1,500 per year now costs $60,000. The dollar had not collapsed. It had just eroded slowly, invisibly, until an entire generation did not remember what real money looked like. But silver remembered. The technical analysts were now paying attention. Charts that had been ignored for decades were suddenly on every trading desk screen. The gold to silver ratio was the most important. Throughout history, gold and silver had traded at an average ratio of 55 to 1, meaning 55 ounces of silver equaled 1 ounce of gold. In 2026, that ratio was 70 to 1. Silver was historically undervalued relative to gold by 27%. If gold was trading at $2,800 per ounce, silver should be at $51. But gold was not staying at $2,800. Central banks were buying gold at record levels. Institutional investors were adding gold as an inflation hedge. Analysts were projecting gold to reach $3,500 by 2027. Some were calling for $4,000 by 2028. If gold reached $3,500 and the gold-silver ratio normalized to 55, silver would be $63 per ounce. If gold reached $4,000, silver would be $72. But that assumed the ratio stayed normal. History showed that during monetary crises, the ratio did not normalize. It inverted. In 1980, the ratio briefly touched 17 to 1. Silver was outperforming gold by a factor of 3. If that happened again in 2026, if gold went to $3,500 and the ratio hit 17, silver would be $206 per ounce. The $200 target was not speculation. It was what happened when you combined 3 undeniable forces. Force 1, monetary debasement. Every major currency was being printed into weakness. Force 2, industrial demand. Solar, EVs, defense, and 5G were consuming silver faster than mines could produce it. Force 3, investor awakening. After 50 years of ignoring physical assets, capital was rotating back. The Nvidia comparison made this clear. Nvidia had a market cap of $4.6 trillion based on future earnings, based on the promise that AI would change the world, based on hope. Silver briefly matched that at $35 per ounce. But silver's value was not based on hope. It was based on periodic table reality. It was based on guaranteed industrial consumption. It was based on 5,000 years of monetary history. If Nvidia's valuation was justified by potential, what was silver's valuation justified by? The answer was forming in the minds of portfolio managers across the world, and that answer was higher than anyone was publicly willing to say. For the business owner, the entrepreneur, the decision maker, the question was no longer whether to own silver. The question was how much. The conservative allocation was 5%. The aggressive allocation was 15%. But allocation was meaningless without understanding the vehicle. Physical silver, bars and coins, provided true ownership but required storage and insurance. Silver ETFs provided liquidity but carried counterparty risk and paper claims. Mining stocks provided leverage to silver prices but came with operational and political risk. Each had trade-offs. Each required due diligence. But the underlying thesis was the same. In a world of infinite debt and finite resources, in a world where governments could print currency but not metal, in a world where technology demanded silver and mines could not supply it, the trajectory was set, not by speculation, but by mathematics, not by manipulation, but by reality. And reality was pointing to $200